I personally believe that this is going to be pretty short-lived. I think that the markets are going to find a bottom this week. I think I'm going to go on record, and I'll probably be wrong, but I'm going to say tomorrow actually is going to be a very green day as unemployment claims come in much below expected. And I think that's going to cause a new risk-on trade, or the risk-on trade to return, which is going to mean stocks, Bitcoin, whatever asset you have is probably going to be very green tomorrow. Well, I hope everybody's having a fantastic day. It's hard not to have a good day when the Nasdaq's up more than 3%. Small caps are up more than 2%. If I can change the screen, there you go. And Bitcoin is up more than 8% on the day. And if you were net long on any assets right now, chances are you had a really good day. So that goes directly against all of the influencers and all of the people on the internet and on CNBC that were telling you to sell your stocks immediately. And fun fact for you, the S&P 500 today had its largest one-day gain since November of 2022. So basically its largest one-day gain in the past 2 years. And if you listen to everybody else that was fear-mongering in that echo chamber, you would have missed one of its biggest days in the last 2 years. I've said that 3 times now. But the reason that's a big deal is because there's studies out there that show if you miss the market's best 10 days over the past 30 years, your returns would be cut in half. This is research that's readily available. And the fact of the matter is sometimes the market's best days come after the market's worst days. If you miss just a handful of those, your expected investment return long-term goes way down. And this is why I've been so adamant that other influencers, when they're telling you to sell your stocks, I feel like they're doing a major disservice to their viewers right now. But I'm also biased in my economic data and the research I do. I personally don't see a recession out there. If you've followed my channel, you would know that. But yeah, I mean, that's pretty crazy. Anyways, today we're going to talk about some economic data. We're going to talk about consumer credit, which I know a lot of you are concerned about. And then we're going to talk about an update to the bullish sentiment in the stock market. And at the very end, I'm going to give you a treat. I'm going to talk a little bit about the Microcap AI stock that I've been buying. Palantir, NVIDIA, they get all the limelight because they're 2 of the only companies in the AI space that actually make money because of AI. This Microcap stock is another one of those companies that nobody knows about, and they reported earnings today, and there's some very interesting information. So I'm going to talk about that at the end of the video. If you're new here or returning, not yet subscribed, please subscribe down below. On your way down, hit the like button, leave me a comment and tell me if you've been buying stocks or if you've been buying this dip, and give yourself a pat on the back if you've been doing so, because you had to go against what the masses were telling you to do, and that was to sell your stock. So bravo to you, but let's talk about this. This morning at 7:30 a.m. local time, this was pretty early in the day, we got an update on initial unemployment claims. And just like I figured, and I don't want to sound cocky at all, and I'm running the risk of doing so, but just like I figured, they came in less than expected. Initial unemployment claims actually fell. Over the past couple of weeks, I've kind of done my best to dispel, the labor market data that everybody was freaking out about and this SOM rule. And I think we've done a really good job of that. And this data release this morning caught everybody off sides. That's why you had such a profound market reaction today. I should say everybody off sides except people that watch this channel. But we've talked about this. The labor market, when you really dig into the data, is very strong. 87% of the national increase in initial unemployment claims 2 weeks ago came from the state of Texas, which is where Hurricane Beryl made landfall. That is a big deal. And we also know that the uptick in unemployment, when we look at the data that nobody else wants to look at, it comes from re-entrance or new entrance into the labor market. It's not people that have jobs that are losing jobs. It's people as a result of immigration and even illegal immigration that's actually causing the unemployment rate to steadily rise. We've talked about this, and that's why this morning I wasn't surprised at all to see initial unemployment claims fall. And you can see it on this chart here. Another thing I've mentioned previously is it seems like there's this kind of a new post-pandemic trend that the Bureau of Labor Statistics hasn't caught on to yet, some seasonality stuff, because for the last 2 or 3 years, we've had this same trend where initial unemployment claims rise during the middle part of the year and then they fall at the end of the year. And I think this is a direct result of some seasonality changes. I mean, the pandemic, it changed our world in so many different ways. And I don't think it's profound to make the claim that it also changed some of our labor market data. We've also had some information, I think it was the state of Minnesota, where over the course of the summer months, teachers can file for unemployment benefits, and that's boosting these numbers. Just things like that the the Bureau of Labor Statistics hasn't really caught on to yet or hasn't adjusted for yet. I think there's a lot of that out there. And so this is just the same trend we've been experiencing. Again, a lot of one-offs or random variable events like weather-related stuff that's caused initial unemployment claims to rise and the unemployment rate to slowly rise. But I think, the trend's going to be down from here. I don't think it's going to go higher. At worst, I think it's just going to stay flat where it's at. But yeah, it's kind of funny how all of a sudden everybody's calling off this recession that everybody was just so adamant was about to happen, or we were already in one, just as a result of one data release. It's just absolutely crazy how emotions drive the stock market. And I've learned at a very young age, you have to keep your emotions out of your business decisions, out of your investing decisions. Otherwise, you're going to make stupid choices that cost you over the long term. But just as I thought, as soon as people realized because of this data release that, the labor market's actually okay, well, the risk on trade returned today. And I think, your portfolio proves that. So we did well with this one, community. So good job. But let's talk about something that I actually am slightly worried about. And it's the consumer credit report. And this came out yesterday. And it actually showed a decrease of $1.7 billion in revolving credit month over month. At first glance, you might think that's a really good thing. People are paying off their credit card balances. But the markets don't like that because that's generally not the case. It's actually usually just indicative that consumer spending is slowing down if revolving credit declines. The 12-month average monthly change was an increase of $6.5 billion. So this was a major divergence from the trend, a decrease of $1.7 billion in revolving credit month over month. I mean, that's just astounding. I will say consumer credit usually isn't something that causes a recession, but it's something that can make a recession worse, if that makes sense. For example, it might be hard to see on this chart here, but this purple line shows you household credit card balances, and you can see it's slowly been rising steadily, basically since the end of 2020, early 2021, and it is a problem because it's reached $1.1 trillion on credit cards. I mean, that is a lot of money, and there's this thesis out there that people have been financing their lives and purchases on the credit card via credit. And I'm sure some of that is partially true. It might be mostly true. I'm going to tell you now why I'm not as concerned about this as most other people are. First of all, when people present this consumer credit data or any debt data for that matter, they miss the point. They're kind of misleading. Like, of course, debt balances are at all-time highs. We've printed trillions of dollars just in the past 6 years. It's astounding how much money we've printed. So it's no wonder that both asset prices are at all-time highs and debt balances are at all-time highs. There's just more money in the system. The reason I'm not as concerned is, this is reason number one. We can look at consumer credit outstanding as a percent of disposable personal income. So disposable personal income is basically the income left over after your needed expenses. This is fun money. You can think of it as fun money. And based on this chart, consumer credit outstanding as a percent of disposable personal income has been falling since 2021, which means that consumers have been able to finance or afford this debt easier as time has gone on because their disposable personal incomes have either risen or their credit card balances or consumer credit balances in general have fallen, or a combination of the two. Despite what most people say, it actually is easier to afford the credit card balance right now. Another chart we can look at is the household debt service ratio. This is very similar. It's the ratio of debt service payments to disposable personal income. And you can see historically, we're actually close to lows, other than in 2021 when interest rates were zero and people were making a bunch of money because the government was giving us free money to spend. Right now, this ratio is at 9.8%. So this means that the total debt service payments outstanding only make up 9.8% of total disposable personal income out there. That is compared to in 2008 and 2009, basically 13.5%. We've been coming down quickly ever since then. And at 9.8%, this doesn't make it look very expensive to afford credit right now. Now, I don't want to act like I'm blinded. Clearly, there's people out there that are struggling to make debt payments. That's a real thing right now. But for the most part, when it comes to the masses, I mean, we can talk about pockets of the economy all we want. And yeah, that pocket is struggling right now. But as a whole, the economy is very strong, and the data is going to show that. Usually this doesn't become an issue, servicing debt, until people start losing their jobs. And I've talked about the labor market endlessly over the past week or two. I've pulled up this chart in the past. This is announced job layoffs. It actually plummeted downwards. If we were about to enter an unemployment-led recession, the announced job layoffs number would actually be skyrocketing, not falling. And another piece of this that I don't think people are paying attention to is just a big demographic thing. Baby boomers right now, they're all entering retirement age. They're retiring with a record $78.6 trillion of net worth with an itch to spend their money. And the pandemic only made that itch more itchy, if that makes sense. $78.6 trillion of net worth. That is crazy. That is a crazy amount of money. And this money can go to many different things. It can go to investments in real estate. It can go to spending at restaurants or the movie theater or any sort of entertainment. It goes into the economy one way or the other. And if it doesn't, you know where this money goes? It gets passed down to the next generation. And it's a known fact also right now that more and more often kids are moving back home with their parents. And their parents have money. This is a known fact. They can help provide for people that are struggling, their children that are struggling. They can help provide for new families, paying their bills, paying down their debt balances. This is a real thing that's happening. But again, I mentioned we can talk about pockets of the economy that are struggling. And sure, there are many out there that we can name, but as a whole, there are just so many massive trends at play that are holding up this economy, holding it up as a whole. Despite those small pockets that are struggling, the economy as a whole is doing very well because of these things I've mentioned. The labor market is very strong. People aren't losing their jobs for the most part. Household net worth of the baby boomers who are retiring is at a record $78.6 trillion, and it's not even close. It's not even close. And then we have the fact that as a result of the great financial crisis and the great virus crisis, the Federal Reserve has learned how to be more active than ever and be successful at being active. This chart here shows you the Fed's liquidity facilities. You can see how the Fed's liquidity skyrocketed during the great virus crisis. Very smart thing to do. It saved our economy and probably saved the global economy. And then here in 2023, you saw another spike. What was this? It's that banking fallout, that small financial crisis we had in March of 2023 when Silicon Valley Bank failed. The Federal Reserve, I've said this so many times on the channel, has learned how to play whack-a-mole whenever an issue arises. Throw money at it, throw money at it, throw money at it, and it fixes the problem. It contains this crisis. In the past, it's been crisis events that the Fed has been unable to contain that ended up causing a credit crunch and ultimately an economy-wide recession. You see, nowadays is different. And as long as the Federal Reserve stays active, I struggle to see a scenario play out where we have a significant and real stock market crash, unless we get another black swan like the great virus crisis. But even then, the stock market recovered really, really quickly because of the Fed. I guess what I'm trying to say is I think the end game here is going to be another bubble forming. It's going to be another market melt up. As long as the Fed is active with this, there's going to come a time where they throw money at the system at a problem that doesn't exist. And that's going to cause a lot of inflation along with some other negative catalysts to the economy. And ultimately, that's going to cause the Fed to have to raise interest rates even higher, maybe to double-digit percentages. And that's when I think the stock market bubble will pop. But that could be years from now. Maybe I'll eat my own words here, but I think the next major sell-off it won't come for years, and it's probably going to be really painful. I mean, I think the bubble we're going to form is going to be bigger than any other bubble we've formed in the past. Sure, we're going to have bear markets throughout all of this, but I think the general trend is going to continue to be higher and higher and higher. I don't know. It's just interesting to think about. But let's talk about this. This chart here is actually bullish from a contrarian's perspective. The bull-to-bear ratio. So this is just investor sentiment in the stock market. We were sitting at levels we had only seen basically 3 times going back to the 1980s. This number of the bull-to-bear ratio has fallen significantly as a result of the Japanese yen unwind and the volatility index short squeezing and people selling their stocks and all of a sudden becoming, bearish on the stock market, which ended up being a mistake. I think, today is only one day, but I do think it was a mistake, and we'll see if that really is true over the next week or so. But the bull-to-bear ratio is now back down to 2.51, and this is the average it's actually slightly below the average over time. And this means that we have converted some fake bulls back into the bearish camp, and that gives the stock market ammo. It's basically gunpowder for the stock market. When you have more people in the bearish camp, you have the ability to convert more bears into bulls. But, when we were sitting at a bull-to-bear ratio of 4.5 to 1, I mean, the amount of bears in the bearish camp that you could successfully convert into the bullish camp and get them to buy stocks is very limited, because at that point, the bears are likely perma bears, which is the stupidest thing you could ever do. I've also said that before, but being a perma bear on the stock market, you got to be crazy to do that. But anyways, yeah, this is bullish from a contrarian's point of view. It means that there's gunpowder, and it means there's ammo for this bull market to continue, and I think it will continue for a very long time. This being said, the NASDAQ, for example, is still basically 11% off of its all-time highs that it set on July 10th. I think that the NASDAQ and the S&P 500 will continue to chop below their all-time highs up until basically election time. However, I do think that the laggards during the next few months will become the leaders, meaning the mid-cap companies. I've talked about this endlessly on the channel, how times are changing. Small cap earnings growth is growing. It's expanding. It's looking better and better. And the large cap companies, their earnings growth is slowing. And this is the first time that's happened since 2021. I think the market's going to be caught off sides when they realize that the small caps are finally outpacing the large caps in growth again. You also have the fact small caps are much more economically sensitive and interest rate sensitive. And obviously with interest rates set to come down, again, I don't agree with it, but interest rates are set to come down. It's going to benefit small caps and mid cap companies. And any stock really that's been beat up unfairly, it's going to benefit. And so, yeah, I've been positioning myself accordingly. I always try and beat the markets to the punch. That's what you have to do if you want to maximize your gains. You actually want to be early to what you invest in, because that means you make money when everybody else catches up to you, right? So you want to be in front of the pack when it comes to this stuff. One of the companies I've been buying reported their earnings today, One Stop Systems. I'm going to refresh the page, but as of now, One Stop Systems is down 8.3% after reporting their earnings. I've discussed this company a little bit on the channel in the past. It's one that I want to keep buying. It is definitely a long-term play. I don't expect One Stop Systems to go to $100 overnight. It's not a penny stock like that, where you're just going to see outsized returns. This is very early innings for this company. The reason I like it is because, based on my research, I think real AI happens at the edge, not in a remote data center somewhere where there's any amount of latency. That stuff has existed for years. We call that big data. Actually, we call it AI now. We used to call it big data. That's been around for years. I don't think that's anything special. I don't think that's anything new. What is new and what is special is what happens at the edge, where there is as little latency as possible. Think self-driving vehicles, or think even military applications, where sensor processing has to happen in the snap of a fingers. You don't have time to send that data to a remote data center just to have the data center do the computation for you to send back the answer. I mean, that's way too much latency. To really maximize the return of AI, you have to limit latency as much as you can. And that means that you have to have data centers on the edge. This is what One Stop Systems does. They are basically a provider of mobile, ruggedized data centers. They provide these data centers to the military, the Department of Defense. They provide these data centers to those self-driving trucks or cars. A lot of different industries OSS is getting their foot in the door with. Again, it's very early innings here, but if AI does what a lot of us think it will over the coming decade, One Stop Systems is going to succeed because they're getting in the door early with the Department of Defense and a lot of the major self-driving companies, a lot of the major players when it comes to AI technology. They're getting themselves in the door with it. And by getting themselves in the door and creating prototypes and customized solutions for these companies, they're inheriting, I don't know if inherit's the right word, but they're becoming the incumbent there. And in a space like AI, where you need specialized solutions, being the incumbent is going to be huge over the coming decades because switching costs go through the roof if you are the incumbent and your customer wants to switch providers of this mobile ruggedized data center. So this even exceeded my expectations. The revenue numbers, I mean, they weren't special. There's a reason their revenue has been declining. They manufactured it. They got rid of their low margin media customer. That's why revenues have come down for the most part. But what really impresses me and what really excites me about this company is this new line item, customer funded development. They talked about last quarter how this line item will be increasing. It increased much more than I thought it would. During the 3 months that ended June 30th, so in the earnings release they had today, this revenue number totaled almost $1.5 million already. That is a huge deal. These are customers paying for prototypes and development of these specialized AI data center solutions, whether it's sensor processing, you name it. These are early stage companies that are investing in the future of AI. They're taking it legitimately, and OSS is their provider. So while this is not a huge company right now, it very well could be a huge company 10 years from now. And the best part of investing in companies like this is you can keep your initial investment pretty small and you can make a boatload of money long term. And if it doesn't work out, you don't lose that much money. I personally think this will work out because if you look at their finances or financials, One Stop Systems has been profitable in the past. And they're probably within half a year of being profitable again already. Early days in AI. They're already profitable. I mean, it's crazy to think about. In this company, you know, it's another one of those that what I say the market cap was, $45 million market cap on it. Over the next 12 months, they're going to well exceed their market cap in revenue, and it's probably going to be profitable revenue. So just on a tangible basis, the current financials, I believe this stock is undervalued. Again, I don't think the real returns are going to come until 4 years down the line, maybe, and it's going to happen quickly. This could become one of the bigger AI plays in the entire stock market. I hope I can come back to this video, clip this little segment, and show it here in the next 5 or 10 years. Boy, I'm going to be, 28 years old in 5 years? 33 and 10. Oh man, time's going to fly, guys. Time's going to fly. But I mean, that's why I'm thankful for everything you guys give me. I get to do what I love for a living because you guys support me. And if you want to support me even further, your viewership is enough. But if you want to go further, you can get some pretty cool perks by joining my membership. You can get access to my price target spreadsheet, extra due diligence on companies like One Stop Systems. And if you don't find value in it, I have a 100% refund policy, and I haven't had to refund anybody. So just join the dang membership. It helps me out tremendously. And again, just thank you so much for giving me this opportunity. I love what I do. I can't believe I get to wake up and do this every day. With that, I hope you have a great rest of your day. Hope you enjoyed this video. Let me know if you've been buying the stock market dip down in the comment section below. I think I said have a great rest of your day, but I'll say it again. Have a great rest of your day. Stay blessed. Keep 10 toes grinding your chin up. Peace out.